right, welcome to the channel. Today is a big day. The printing machine is working. Let's get straight into it. Today we're going to start off, as always, looking at our CNBC watch list, what we use for our puts and calls. So as you can see here today, what makes this a really good day, most of the stocks that we like that's selling at low prices are coming down. A lot of the stocks that we like and that we own are actually rising. We didn't do anything with Occidental Petroleum today, but UPS down $4.48. Good news for us. Nike's down $1.81. We're not selling any calls again because they report this week. And we sold Starbucks was down more earlier, but it's down 59 cents still. And Hershey's is down $1.65. Those are the stocks that we don't own yet. If we did own shares of them, we would be at these prices. We would be happy with that price. So of course we're willing to sell puts into them. Today, Meta, it was up earlier today. It was up 10. Google was up, which, as you know from my past video, I already have an option out there on that. So I didn't sell any against that. And we have Amazon, which was up at one point today about $3 when we sold our calls today. So it was a good day today for trading. So UPS, as I said, we sold the 131 strike. Starbucks, we sold the 176 strike. And Hershey's, we sold the 180. And remember, we sell these options. Meta, I believe we sold the 145. I want to make sure I cover this. We sold the 145 strike. And Amazon, I believe we was able to sell the 197.50 strike. So we're real comfortable with all those options. The ones we sold puts on, we'd be willing to own. The ones we sold calls on, if we had to sell the shares, we would, especially at the prices that we put out there. But as you know, we do the rollout, so we're not even really worried about that. So that's why the printing machine was printing good today. We made really good money today. So I kind of, as I make these videos, I kind of want to go back and explain the beauty exactly of what we're doing. So when we have shares and we own some other stocks that we're not selling options on, but our Meta, Google, and Amazon, they're up significantly. We bought them at the bottom of the market in 2002 because we're value investors, and we've risen them up this high. And so now they're at the point that we can sell calls against them. And then with the put stocks that we're selling puts on, we like the stocks. We like UPS, we like Nike, we like Starbucks, and we like Hershey's. They pay, most of these companies pay really good dividends. Some of them are going through temporary problems, like Nike's having problems with their new products and has built up inventory. And so when we own a stock and we sell calls against it, that means we own a stock. But what's even more beautiful, and that I'm going to break down today, is when we don't own a stock and we sell puts against them in the situation that we're in now. And we're doing all this just to build up wealth because we think the stock market is overvalued, and our game that we love the most is to buy good companies at good prices. And there isn't a whole lot of companies, real good companies that's selling at low prices. So, this is what we're doing now. But when prices do come back down, we will start allocating capital. So what we're doing, we're going to act like we bought 2 bonds a day. So we're just going to break down the numbers of how we play this game so that those out there can kind of really, truly understand. So today we're going to act as if we bought a $30,000 T-bill. And when we talk about T-bills, our T-bill is normally 90 days out. So a T-bill today that we did actually buy was selling at 5.34%. So at 5.34%, 90 days out is going to bring us in about $400. So some people, that's what they do. They buy T-bills. Sadly, some people keep money in a savings account. But we're buying T-bills with this. So with that $30,000 T-bill that we purchased today, we're not just going to let that money sit in that T-bill. We're going to use that same $30,000 that we know when it expires, and because we have some expire every week, we know we got money coming in every week, and so what we do is we sell puts against stock. So if we're using the number 30,000, that's kind of where we would keep a put that we sell at. So we're going to act as if we did UPS. So today let's say, and I don't know exactly how much it brought in today, but let's say we sold the 131 strike that expires on June 28th, and today is June 25th. So we're talking 3 days from now when this option does expire, where and it can't be below 131. And if it is below 131, as you know, we'll do the famous rollout strategy, which we've made a really good video. It's called repositioning. I really strongly suggest that you go back and watch that. So what we're doing is, so let's say we made $50 a week on selling puts against UPS at the strike prices that we're at. So at 131. So if you do the math, it normally is 13 weeks. The options normally go out. I mean, the T-bills normally go out. So if we know we're going to make $400 on that T-bill that we got $30,000 in, and then we're going to make $650 if you do the 13 weeks, $650 from the time that T-bill get ready to expire. So that means the $400 not only to make the T-bill, not only to make $400 on the interest that we earn, but we also made $650 on T-bills, which brings your income up to, for that 3-month period, up to $1,050. And if you do the math on that, that's about 16% a year that we're earning while we're waiting on the stock market to drop. So we're not just putting money in T-bills and letting it sit there. We're selling puts, and we're putting the puts out there to generate more income. And we could go up, we can come closer, like 134, we could sell the 133 strike, and we'll earn, I mean, instead of earning $50, $60, we'll probably earn $200. But and we don't want to do that because we really don't want to be assigned the shares. So, and if we do know it do come to that price, we're gonna roll it out. So I hope you kind of understand it. I wanted to take the time to explain, because we're like double dipping. We're earning interest, and then we're earning T-bill money. And in the worst case scenario, if it was assigned and we wasn't able to roll out, we would just go ahead and be assigned, and that could sit in our margin account until we get ready to be assigned. And now our interest will be a little less because we'll now be paying interest on the money that we borrowed. But that's the worst case scenario. But normally we're going to roll it out. And if we're going to be assigned when we want to be assigned, and when we be assigned when we want to be assigned, we'll have that money in the account. So I kind of hope that kind of explains it in a little more detail. You have to keep watching the videos to kind of get a better understanding. You can comment. I'll comment back and kind of explain it to you, a little bit more if that's what you want, or if it's enough material that I need to make a video on, I'll make a video specifically for you. But I hope this information was helpful. If it was, please like, please subscribe, please, so we can expand this channel so we can get more people printing money.